Chief Financial Officer, and the Investor Relations team. I'll now hand over the call to Mr. Kanwar for his opening remarks, post which we will start Q&A. Over to you, Mr. Kanwar.
Well, thank you, and a good afternoon, everyone, and a very warm welcome to Apollo Tyres Q3 earnings call. Let me start by thanking all our stakeholders for their continued support, which has helped us report another healthy quarter, despite our several headwinds. The results during these difficult times gives me immense confidence on the way forward, and as I said during our last interaction, we remain extremely bullish in the long and medium term. While the pandemic situation continues to unfold, I would like to take this opportunity to thank the Indian government for successfully managing one of the largest vaccine drives ever undertaken. As per the latest economic survey held by various regions, including widespread vaccine coverage, Indian economy is expected to grow at 8 to 8.5% in FY23. And Apollo is very well placed to leverage this growth. Moving to the business, the quarter was once again impacted by rising raw material costs and a third wave of COVID that hit India. On the positive side, latest COVID wave in India did not result in any huge supply chain disruptions, and our European operations reported another very, very strong quarter. We continue to expand our product range and footprint across key markets. The pricing environment continues to remain steady, and we have been able to take price hikes in Q3 as well. Going forward, we will keep a close eye on the markets, and we intend to take further price actions at the opportune time to reach our targeted margin range. We continue to work on key focus areas. During last 2 years, the teams have worked extremely hard in a very difficult environment to lay foundations for a bright future, and the results are already starting to show. Our strategic actions in Europe, along with the relentless focus on enriching our sales mix, has helped Europe manufacturing and sales operations report a double-digit growth in top line, and more importantly, our EBITDA margins were in excess of 20% in the current quarter. The share of UHP and ultra-high performance tires in Europe today stands at 43% of the entire pie. We have been talking about increasing focus in this segment, and I'm extremely happy to share that the journey has been steeper than that was targeted and has been one of the key drivers of profitable growth in Europe. Similarly, in India, we continue to enrich our sales mix. We've recently launched our premium car tire brand, Flairstein, in India, and this should help us further accelerate our journey towards premium space in the Indian passenger car segment. Similarly, we are at the forefront of driving radialization in segments like light truck, commercial vehicles, two-wheeler radials, and this should further help us enrich our product mix in our domestic market. We are further growing our presence in the OHT category to continue to drive towards a richer sales mix. The efforts on developing new markets is paying off in terms of sharp growth in developed profitable markets like North America, and would further enhance growth in profitability in future. Furthermore, after successful execution of the specialization of the Enschede plant, we have optimized our European manufacturing blueprint. The results of the same are clearly visible in the strength of our consolidated margins, despite steep raw material cost push. In fact, Q3 has once again highlighted the underlying strengths of our business model, a diversified and a de-risked business model. Our continued focus on R&D and digitalization are some of the key pillars of our ever-evolving business model and ensure that we are future-ready. Among other areas, specific tires for electric vehicles has been one of the key focus areas for the R&D team. We are cognizant of changes in the automobile and mobility space and are fully prepared to leverage the upcoming opportunity. While the EV space is at infancy and is evolving, we believe growing preference for EVs would impact tire industry positively. Work by our R&D teams ensure that we remain very well placed to leverage this opportunity. Another important area of work for R&D is sustainability. Our R&D teams are helping us increase usage of recycled material and sustainable material as we move forward. While we are still in early stages, I will come back with more qualitative and quantitative information on our work on all these areas in the next due course of time. Digitalization has been another thrust area for us as we are preparing for the future. We are not only leveraging digitalization to increase or improve market engagement through customer digitalization, but also undertaking projects like digitalization and integration of our supply chains, our journey towards Industry 4.0, and centralization and transformation of our back office processes to drive our efficiencies. Lastly, but not the least, we believe sustainability is one of the basic pillars of business, and there is a lot of work happening on this front. Some of the work being undertaken under our sustainable journey are as follows. A, focus on increasing usage of recycled and sustainable raw materials. Secondly, reducing usage of fossil fuel, achieving efficiency to achieve sustainable manufacturing. Number 3 is reducing our carbon footprint in distribution and supply chain by usage of electric vehicles, improvement in supply chain efficiencies. And lastly, the work of the end of life of our tires. I want to reiterate that sustainability is a key focus area for Apollo, and I'll keep on coming back with updates in this regard as we go ahead. Finally, in terms of outlook, we are optimistic about demand momentum, although cost inflation could continue to weigh on operating performance in the near term. We will continue to work on negating RM cost pressure through improvement in product and enriching our channel mix, selectively and well-timed pricing actions across our key markets. The team is highly motivated and are focused on achieving our vision of 2026. We continue to cost control and be judicious about CapEx to ensure focus on profitability and the return on our capital. Going forward also, we will focus sharply on free cash flows and on growth CapExes. With this, I would like to conclude my opening remarks and hand over the call to Gaurav. Thank you. Stay safe. God bless. Gaurav, over to you.
Thank you, Neeraj, and good afternoon, ladies and gentlemen. Continuing from where Neeraj left, let me start by reiterating our commitment to the health and well-being of all our stakeholders. Let me first address the most recent matter which would be there in your mind. CCI's order of yesterday evening imposing penalty on 5 tire manufacturers and our association ACMA. The company does not agree with the findings of the commission and will take necessary steps under the law to appeal against the order after a more detailed examination of the full order. Moving back to business operations, in India, the much anticipated economic recovery in second half has been delayed. Softness in the demand environment from November onwards, coupled with continued RM inflation, impacted our operating performance in Q3 of FY22. On the positive side, in spite of a weak demand environment, the pricing environment remained stable. We've taken small price increases across categories in replacement segment, but we need to take further price increases going forward, as Neeraj mentioned, to fully pass on the RM cost inflation. While our margins were impacted in the last few quarters given the steep cost pressures, we remain committed to achieve our mid-teens EBITDA margin target in the medium to long term. As highlighted we have witnessed over the last 4 quarters, the Europe operations once again underscored its relevance as a market, along with the benefits of diversification and de-risking of business model by reporting very strong operating performance in Q3. While the demand environment is in a better shape, these are still uncertain times. given the various strategic and operational measures taken through last 2 years in both India and Europe operations, we are far better placed to face the current situation. Moving to the financial results, the consolidated revenue for the quarter stood at rupees 57 billion, a growth of 10% over the same quarter last year, and a growth of 12% on a sequential basis. On a YTD basis, the revenue stood at rupees 154 billion, a growth of 24% over the same period last year. The consolidated EBITDA for the quarter stood at rupees 7.4 billion, a margin of 13% compared to 19.8% in the same period last year, but sequentially up from 12.6% in the last quarter. YTD basis, the EBITDA stood at rupees 19.5 billion, a margin of 12.7%. The margin performance for this quarter and the current year have been impacted by the steep increase in RM cost, while we continued a tight lid on other costs. Coming to the balance sheet, we've been able to maintain our leverage ratio given the strong focus on cash flows. The net debt to EBITDA was at 1.8 times. In India operations, the revenue for the quarter was rupees 37.9 billion, a growth of 11% over the same period last year and 4% on a sequential basis. There was a very strong growth in exports, though the OE business was a slight decline sequentially. In terms of product categories, the demand was weaker in the TBR and the farm segment. On YTD basis, revenue stood at rupees 107 billion, a growth of 32% Y-on-Y. The EBITDA for the quarter at rupees 5 billion was a margin of 9.1%, down sequentially from 10.3% in the preceding quarter. The Indian operations, while facing these headwinds, continued to maintain a tight control on inventory and capex to tackle the situation. We see signs of demand picking up, which should flow into the results in near term. Moving on to European operations, the revenue for the quarter were a record euro 167 million, up 19% compared to the same period last year and 21% sequentially. Even on a YTD basis, the revenue was up 16% compared to the same period last year. We continue to make inroads into the market and grow, and have gained market share across product categories. The UHP mix in the PCR segment is at 43%, a significant improvement in line with our vision that we have been talking about. The EBITDA for the quarter at euro 34 million, as mentioned by Neeraj, crossed 20% compared to a below 16% for the same period last year. For the 9-month period, we are looking to report record EBITDA numbers in the current year. We are at 77 million euro currently, a margin of 18.3% compared to 10.3% last year. This margin recovery has been on the base of the restructuring that was carried out, but supported by strong volume growth, improvement in product mix, manufacturing cost optimization, and cost containment measures. With this, I conclude my opening comments. We would be happy to take your questions.
Thank you, Mr. Kanwar. Thank you, Gaurav, for your opening remarks. So now we will begin with the Q&A. Anyone who wishes to ask a question, please use the raise hand option on Zoom. We will start with Ashutosh Tiwari. Ashutosh, you can unmute yourself and ask your question.
Yeah, am I audible?
Yes, Ashutosh.
Yeah, hi, congrats on a strong Europe performance during the quarter. My first question is, in Europe, you already reached in this quarter 43% sales of UHP tires. I think earlier you were talking about 35-36% is a target. So how should we read it? Is it like a quarter phenomena, this high number, or this can sustain going ahead?
No, very clearly, this is not a quarter phenomena. It is a sustainable customer acquisition. Also, I want to tell you that all the products that are in the UHP and UUHP in the test results are holding podium positions. So they're either number 1 or number 2 in the Vredestein brand. And therefore, we are gaining market share, and the pie has gone up from 36 to 43%.
And generally, historically, obviously, third quarter has always been the higher margin because of winter tire sales. But considering that UHP mix has gone up and probably you're saying that can sustain also in the subsequent quarters. So I'm not talking about Q3 margins, but generally margins will remain on the higher side in Euro operation going ahead versus probably what we were guiding last year when restructuring happened.
Yeah, so there are 2 or 3 points that you must keep in mind. These profit margins will be sustainable. I'm not saying they will be at 20% or 15%, but they will be on the higher side. Given 2 or 3 things actions that we've taken. One was obviously the restructuring of the manufacturing base. As you know, tires have moved into Hungary and into India. With this, what has happened, the cost of manufacturing for Europe has come down drastically. Even Enschede plant, which was restructured, the cost of manufacturing has come down. Hungary continues to come down as far as manufacturing is concerned. So that's one big point. The second point is because of the enrichment of the product mix, you will have more profit margins. And lastly, OHT is playing a very important role. And as you would know, Vredestein in Europe, in the OHT segment, in agri/OHT, has a very pricing premium position. And that market is growing. And so that will be another part of the profit pool into Europe.
So are we seeing good growth in that OHT segment as well, like say in the recent quarters?
Yes, we are.
And lastly,
we'll continue to grow. As you know, we are supplying from India and from our Dutch plant.
And lastly, coming to India, there's a lot of margin pressure because of price increase, delay in taking price increases. Now, are we planning any price increase in the current quarter? That's one. And secondly, how is the demand? I think Q3 was a bit weak in replacement market, but how do you see the demand picking up now, maybe from February onwards?
So your first question, yes, the answer is yes. We will keep on correcting our prices, and we are correcting in quarter 4. We have already announced price increases in various product categories, and we'll continue to do because there is a lag effect, like you said. So that's a challenge, and we'll continue to take small steps in increasing our prices. On your second point, as far as demand is concerned, we are seeing a very upbeat demand in quarter 4. And this is coming basically on the back of a lot of infrastructure projects that are going into the country. And in the recent budget also, you have seen that India will be spending on roads infrastructure a lot more than what they were spending. Already we've got projections from the OEMs for the quarter 4, specifically in CV. They've been very bullish. It's gone at least 100% more than what it was in quarter 3. Even in PCR, the semiconductor issue is a bit stable. So we are also seeing growth in PCR. The agri industry still is at a low level. But given that the season will start in March, we are pretty optimistic that agri will also come back.
Okay, thank you and all the best.
Thank you.
Next in line, we have Raghunandan AL. Raghu, you can go ahead.
Thank you. Thank you for the opportunity. Congrats on the strong Europe performance. Firstly, on capacity, the YTD capacity utilization is strong in India at over 80%. Can you talk about how you look at expansion? Would you focus more on brownfield and look at staggered expansion so that company sustains positive free cash flow generation, say in FY23-24? If you can throw some light about your thought process, and also if you can share FY22-23 capex requirement.
I'll take the strategic question and you can give the numbers. So, Abhinandan, we will not be doing any major capex in the next 3 to 4 years. We have, as you know, put up 3 very large greenfield capacities in the past 11 years, which is Chennai and then Hungary and then Andhra. The main thing we are doing now is to look at our debottlenecking of our plants in all these 2 categories, especially in TBR and passenger car radial. We are running at 80%, but we believe that we can enhance productivity through some of the initiatives that we are taking within the company, which is mainly to do around digitalization. So that will give us data. AI and machine learning will give us a lot of data, which will throw up how we can reduce cycle times and increase our productions from the same equipments. There will be some small capexes to try and manage the situation. And the other thing is that we are also now looking at enriching our product mix, is what I mentioned to you in my opening speech. Thereby, I mean that we will target higher end tires, more profitable margin tires, and therefore utilize that capacity in a far better sense to look at more profitable products. Gaurav, you want to throw some light on CapEx?
Yeah, we are in the process of finalizing the budgets. And as Neeraj mentioned, the current levels of utilization will not warrant any big CapEx in India immediately. So we will go the brownfield route and judicious CapEx. The numbers are not exactly finalized, but the India CapEx for FY23 should be in the range of 1,000 to 1,100 crores.
Thank you, Gaurav. That's very useful. My second question, on considering the seasonally strong quarter in Europe, margins have reached double digit at the EBIT level. And even on a YTD basis, margins are very strong. On a sustainable basis, what would be the range of margin you would be happy with for Europe operations?
Gaurav, you want to answer?
So Raghu, as our practice, we will not give out margin guidance. But if we look at on a YTD basis, the kind of Europe results, yes, this is a seasonal quarter and a high, but you can look at our results over the last 4 quarters, and we would very much want to be in the kind of range where we are now over a longer period, and continue to look at opportunities to improve margins further.
Understood. And lastly, on the RM cost, if you can indicate what is the kind of pressure you see on a QOQ basis for Q4, and also if you can share the commodity-wise prices which you kindly share every quarter.
Sure. So going forward, we see the RM costs going up by another about 3%. So there is a small inflation further, which will need to be tackled. On your next question, which is the kind of raw material prices that we've seen in the current quarter. So natural rubber was at around 180 rupees a kg. Synthetic rubber at rupees 175 a kg. Carbon black at rupees 100 a kg. And steel cord at rupees 175 a kg.
Thank you. That's very useful. I'll come back in the queue.
Sure. Thank you.
Next, we have Nishit Jalan. Nishit, please unmute yourself and go ahead.
Yeah, hi, thank you. Thank you for the opportunity. My first question is more on the India side. Just wanted to probe a little bit further on the demand side. You mentioned that we are seeing signs of recovery in demand. Was it only limited to OEMs, or you have started seeing some recovery on the replacement side as well? And secondly, if you can quantify the kind of volume growth that we saw in this quarter and the kind of price hikes we took in last quarter and what we have already announced in 4Q.
Gaurav, who want to take that?
Yeah. Nishit, the volume for the India operations was up 3% vis-a-vis last year. So not a big volume growth given the weak pressure. A large part of the top line growth came through pricing actions. On a sequential basis, again, the volumes were up only 3%. Of course, in Europe, a large part of the gain was volume-led. In terms of pricing actions that have been announced or we will look, it would again be in the region of low single digits, in the region of 2 to 3%.
And Gaurav, on part of demand recovery on the replacement side?
There is a stronger recovery on the replacement, Nishit, that we are seeing. The replacement is also showing signs of pickup. The bigger signs of recovery is on the OEM side where the volumes were down.
Okay. And Gaurav, you talked about a 3% RM inflation that we can see next quarter. Given the increase in crude prices, we would continue to see further price increases, cost increases beyond 4Q as well. Is that understanding correct?
We seem to be, Nishit, seeing some tapering of the RM prices. Too early to say given the uncertainty on crude, but rubber seems to be coming down. So expectation is that we may have seen the peak of raw material prices in Q4 or maybe in Q1 of next year.
Okay, got it. My second question is on Europe. Obviously, 19% YOY growth is very, very commendable. Could you break it down between volume price increases? I would assume there would have been a decent price increase that you would have taken in Europe as well. Plus, this mix would have also helped our ASPs. So, just wanted some color on how volumes growth and all has behaved, and how have you fared vis-a-vis industry?
So the volumes in our Europe operations were up 14%. As mentioned, we have grown faster than the industry. To give you one benchmark figure, in this quarter, the passenger car tire industry for Europe was up 9%, and we grew faster than that.
This 14% would include higher growth that we are seeing in the off-highway and the TBR side as well. So our PV industry growth would be slightly lower than the 14%. Is that correct?
Yes.
And just one last follow-up. You talked about 1,000 to 1,100 crore capex in FY23. FY22 numbers remained unchanged. I think it was around 1,600 crores, if I'm not wrong.
We had changed the 1,600 to 1,800 when the year started, Nishit, on the back of investments into digitalization, etc. We would probably come in lower than what we had guided on that 1,800. So it will be somewhere between the 1,600 to 1,800 for the country.
Okay, thank you very much.
Thank you.
Right. Next, we have Siddharth Bera. Siddharth, you can unmute yourself and ask your question.
Yeah, thanks for the opportunity. Sir, on the capex query again, we were expecting after this big Andhra Greenfield capex, FY23 is likely to be only the maintenance capex generally for the India business. So, can you help us understand of the capex we indicated? How much will be maintenance, or are we looking at any brownfield expansion also?
So Siddharth, there is no major brownfield expansion planned for next year. There will be some overflow as we slow down the Andhra capex, which flows into next year. given the situation over last 2 years, we had slowed down our capex spends. Most of this is maintenance capex plus spends on R&D and digitalization, the two focus areas that Neeraj talked about. There will be some very small brownfield capexes in our existing plants, but no major growth capex next year.
But still, I mean, even if I assume 7 to 8,000 crore maintenance, 7 to 800 crore maintenance capex, will that be the right number? And that probably will then continue over the period.
No, that will not continue as a maintenance capex. This includes capex into the existing plants, given the capacities at which they would be run, including looking at productivity improvements. So it's a mix of capexes going into the existing plants, which is not just maintenance in nature, but also productivity improvements, digital, etc. The true maintenance capex across the operations would be more in the nature of 300 to 350 crores.
Okay, got it, sir. And second is on the RM side, in this quarter, we have seen some inventory adjustment costs also coming in because of the weaker demand. So anything to highlight here in the quarter? Was there any inventory adjustment costs as well?
No, we would have used some of the inventory, but no major impact there.
Okay, got it. And lastly, sir, if you can share the Refencom revenue and margin, that will be my last question.
Sorry, I didn't get your last question, Siddharth.
Refencom revenue and margin for Europe.
Ryfan. Just a minute. So Refencom revenue was 68 million and the margin was 11% of it.
Okay, sir. Thanks a lot.
Thank you.
Thank you. The next in queue is Jinesh Gandhi. Jinesh, you can unmute yourself and ask your question.
Hi, thanks. Gaurav, my question pertains to the RM prices. So any sense on what kind of under recovery still exists at end of third quarter?
Jinesh, we've taken price increases in the replacement segment, etc., ranging between 10 to 12%. In terms of an under recovery, so to say, on an RM side, we would be off by about at least 6 to 7%.
6 to 7%, including what we expect in fourth quarter, or that will be over and above this?
Since fourth quarter is also seeing a further RM increase, so you asked a question about up to Q3, I was mentioning that.
Okay. Got it. 6 to 7% is still 3Q. Yeah. And similarly, in the European market, we have started seeing RM cost pressures as reflected in increase in or reduction in gross margins. So there also, do you expect further increase happening in fourth quarter? And secondly, what kind of price increases are we taking there?
So yes, the similar cost push from the RM side would be there for European operations also. So that would be true of any tire player across the globe. And we have announced small price increases into our summer range to take care of those.
Okay. Got it. Thanks. I'll fall back in queue.
Thank you.
Hi, next we have Pramod Amte. Pramod, you can go ahead with your question after unmuting yourself.
Yeah, hi. So two questions. One is with regard to the industry tire exports. If I had to look at the Tire Association, it looks like there is a very strong uptick in exports, more driven by US and Europe. Wanted to know what is the reason for the same and what has been your participation in this strong growth. And there was a case the industry was making for PLI. Any expectations there?
I think I can speak for ourselves. Our whole de-risking strategy that we have put in place for the past 6 years is now paying out. So in terms of exports, we have open sales and marketing offices in Thailand and in Dubai for the Middle East and Africa. And now a lot of focus into North America with LATAM. And all these 4 markets are showing us very positive signs for the Vredestein brand in passenger car and for Apollo truck bus radial tires. And so our exports have gone up. Gaurav will tell you the exact figure. But year on year, our exports are positively high. And these are going to profitable markets. So we have de-risked ourselves from just being in one country and looking at other profit pools around the globe. Gaurav, can you give some highlight numbers on export?
So Pramod, our exports over this 9-month period on volume terms also has more than doubled. So the growth is more than 100%. So while the overall industry itself has pushed exports into various markets, and there are focus markets that Neeraj mentioned, but again, we've done better than our peers, and our growth is more than 100% on exports.
And Gaurav, is it more for Asian markets or the across the volumes?
It is across.
And is there an industry trend which is more shifting towards US, Europe, and you guys want to catch it up, or you are also participating equally in those segments?
We are an equal participant, and as Pramod, we've been talking, and you would remember that North America is a focus market for us. The R&D team has been working on products to be specifically designed for the North American market, the South American market. Those are now beginning to give results. So this is not a quick strategy of this year alone as we saw an export opportunity. This is something we've been working on for a number of years with teams in place across these few various geographies, which is now reaping the results in this year and providing us, in a way, a de-risking strategy from the just dependence on Indian market alone.
Second question is with regard to the TBR, Indian TBR side. Wanted to check, considering that there are new capacities which are throwing up production into the marketplace, and is the market share is a limitation which is a limitation acting for your pricing action, and how do you see this panning out in next couple of quarters?
Pramod, I believe that the pricing action has been more governed by a weaker demand, because even the current capacity is excess based on the current demand situation. There have been not the appropriate level of utilization of TBR capacity, and hence that demand environment led to pricing action or taking price increases in line with the raw material cost push being difficult. And to a certain extent, there has been, because of pressure on fuel prices and general inflation, a shift back to truck bias. So we've seen a much stronger demand on the bias side, and there our capacity has been running into the 90s.
Thanks, Gaurav. All the best.
Thank you.
Next, we have Vasudev Banerjee. Vasudev, you can unmute yourself and go ahead.
Hi, Gaurav. Thanks for the opportunity. Yeah, so to continue with the similar query last question. So just wanted to know at current juncture, what's the total TBR capacity, what is the level of utilization, and where do we see end of FY23 in terms of capacity?
Sure. So Vasudev, the TBR capacity is a little short of 15,000 tires per day across our 2 plants, which is Chennai and the new greenfield in AP. Our current level of utilization is at about 75%.
And the same thing in TPD terms, ton per day?
In terms of tons per day, roughly You can take 15,000 into 65 kgs roughly. 975 tons.
And the same thing after FY23 end, like when full Andhra phase operation getting operational?
Sure. Sorry, I was talking about this as a steady state. There is only a small scale up that will happen in the AP plant on TBR. There is no further expansion plan on TBR as of now.
So ballpark, one can say that FY23 end capacity will be 1000 TPD, and today we are operating at 75%.
Yes.
Sure. So basically, as you rightly said, that orders from truck OEMs showing that Q4 demand itself is very high compared to Q3. So this 75 can move up if there is a strong demand for next 12 to 18 months.
That is correct. The OE demand moves up quickly, but we are, given the focus on free cash flow, etc., going to be judicious on capex and not going to set up any capacity ahead of time, particularly on the TBR front, given that it's a fairly capital-intensive product category.
So in that way, that will be what can infer that one of your competitor also deferred or cancelled their TBR expansion plan. So broadly, one can say that if upcycle of trucks is there to stay for a foreseeable future and no major capacity addition in TBR. So as you rightly said that you are underutilized in the TBR capacity. So in next 2 years, if demand picks up, pricing power should improve?
Possibly, yes.
Sure. Thanks.
Thank you.
We next have a follow-up question from Ashutosh Tiwari. Ashutosh, you can unmute yourself and go ahead.
Yeah, hi. So firstly, in terms of interest costs and debt levels, will this interest cost go up further from here in terms of quarterly level? What we've seen in third quarter, or now is kind of near to peak?
The current levels, Ashutosh, should be more or less stable. There may be going up on the working capital debt as the revenues grow, but there is also debt repayment that will happen. So there should not be much increase in the interest cost.
Okay. And debt level is around 5,100 crores as of now.
You're talking about India operations or Concall?
Both, and also India, if you can provide separately.
So India, the gross debt levels are slightly under 5,000 crore at about 40, between 48 and 49. And on a consolidated basis, they are a little short of 7,000 gross debt.
And cash is around 1,800 crores?
Cash is about 1,900 crores. So the gross debt is about 5,100 crores on a consolidated basis.
Okay. And like you mentioned that in TBR, utilization is 75%. What is the utilization level currently in PCR, and can you tell us the capacity right now?
In PCR, our capacity utilization is close to 90%. And the India capacity is, with completion of Andhra Pradesh, which is still in a ramp-up phase. So the current capacity is a figure which is always moving. It will cross 50,000 tires per day in India.
Okay, so you're saying 90%, so you're operating at 45,000 per day.
Currently, the capacity in AP hasn't reached its terminal of phase 1.
So how much we are operating right now around in terms of per day production?
I'll have to check that number, so we'll need a little time.
Okay. And lastly, on this Restine in agriculture segment, what would be our market share in European market, and any targets or thought process we have in terms of improving that over the next 2-3 years?
Our market share in the Europe operations is about 6% plus. There are no specific targets to say. I would say the bigger focus of the overall operations, putting aside market shares in a particular product category, is to grow, but more importantly, grow profitably and maintain or improve the profitability levels that we've been reporting now over the last few quarters.
6% you mentioned is the market share in the OST segment.
That's correct.
Okay. And lastly, on this CCI penalty thing, what do you think will be the course of action? Like, say you'll go to higher courts and challenge, or this you first get to tribunal for that? What will your process, if you can provide some color?
So the next step, once we get the order, is to study the detailed order, and then there is a timeline to go and appeal to the appellate tribunal. Okay. And only post that process is the Supreme Court. So it's a fairly long road ahead on the legal recourse side.
Okay. Thank you, and all the best.
Thank you, Ashish.
Next, we have a follow-up from Nishit Jalan. Nishit, you can unmute yourself and go ahead.
Yeah, just one follow-up question. On export side, we did around 1,100 crore revenues last year. So what kind of run rates are we clocking right now? Is the growth looking much higher because last year 1Q was a washout in terms of exports? So just wanted to get a sense on that.
So Nishit, as I mentioned, over a 9-month period, we have more than doubled our exports from India.
No, you mentioned that, Gaurav, but last year 1Q would have been a washout as well, right, on export side, or a very low export. So I'm just wanted to check. So 1,100 crore export run rate, are we looking at 2,200 crores kind of a run rate for this year? Is that correct?
Should be possible. I don't have the figures for this year, but even on Q3 alone, compared to Q3 last year, we are up close to 75%.
Okay, thank you.
Thank you.
We have the last question for the day from Disha Shade. Disha, you can unmute yourself and go up.
Sir, you mentioned about the OEM demand going forward, that it is picking up. Can you throw some light on replacement demand, both in TBR and PCR and two-wheeler, all the three categories? How is the demand?
Yeah, so Disha, the demand is picking up, but we didn't have a decline. So do we have a very strong pickup? No, it's better than Q3, but not the kind of swing that we are having on OEMs.
Okay, so the demand momentum of replacement has continued over Q3.
That's correct.
Okay, both for TBR and PCR.
TBR more, PCR was always fairly strong, so it's more coming back for TBR.
Okay, and compared to last year also it is better, because last year we saw a lot of pent-up demand. Last Q4.
I won't have the figures that readily to be able to tell you figure-wise, more a generic sense right now.
Okay. Yes, sir, that's it from my side.
Thank you.
Thank you. That brings us to the end of the call. I will hand over to Neeraj or Gaurav for any concluding remarks, post which we can close up.
I'd like to thank everyone for joining our conference call, and all the very best and good luck and stay safe. Thank you.
Thank you.
Thank you, everyone. I'd like to thank the management for taking out time. I also thank all the participants for joining in. Thank you.